What is happening, boys? We are back. We are back. And this video is actually going to be very good because all four examples cover all of the ways to place your take profit and all the ways to put your stop loss. So, we're going to talk about this, and I just want to address something really quick. I don't want you guys to get stuck in the loop of thinking there's a certain distance your take profit has to be at all times, and certain distance your stop loss has to be at all times. It's always different. And I actually put my own name to this. I don't think anyone has named this before, but I call it the trade's personality. Now, what I mean by the trade's personality is you have to understand when you take the trade, what type of trade is it? Is the stop loss going to be bigger? Is it going to be smaller? Is it going to be, you have a bigger take profit so you can have a bigger stop loss? Or is there a smaller stop loss so you have to have a smaller take profit? So, I also am going to cover the fact what we are looking for. How much risk to reward are we looking for in every single trade? So, some strategies is 3 risk to reward, some is 1 to 1s, some is like 1 to 6 risk to reward. For us, we are focusing on the win rate. So, lower risk to reward, higher win rate, right? So, we are aiming for between a 1 to 1 risk to reward all the way to like a 2 risk to reward, and if you somehow get a 2.5, that's great, but that's not really what we are aiming for. So really this 1 to 1 to a 1.2 risk to reward. And how to tell, like for all my new beginners out there, how to tell how much risk to reward you are is by doing it like this, right? So get your position out. On the left hand side, you'll see this one over here. It will have a long position and a short position. So you use the short position when you're selling and use the long position for when you're buying in the market, right? So this is the trade that I took last night, right? And it was a nice win, and I'll show you guys why I placed my take profit where I placed it and why I put my stop loss where I placed it, right? So we took this trade. We had the push. Remember, if you guys haven't watched the first videos, go check those out. We had the first push, then we had a retrace. What are we looking for now? The third, which is the second push, right? So we get the second push. Now we don't want to put our stop loss above this level because look how close this is. If we put it right above the level, we are going to get stopped out. You need to give your stop loss room to breathe. I cannot stress this enough. You guys need to give your stop loss room to breathe. We want to be placing our stop loss where we think if price goes and hits our stop loss, there's a good chance price is just going to reverse and go the opposite way anyway, right? So placing it at the level isn't giving it room to breathe because price might come out, stop you out, and they've got to take profit. Many times, yes, I had to learn this the hard way. Many times before, I've learned that if you have a tight stop loss, it's going to hit your tight stop loss and it's going to go to your take profit. So boys, you have to be wary. Don't be greedy. This also runs into the greed section. Lots of people like to have a tight stop loss so they can make more money on the trade because they're focusing on the dollar amount. If you focus on the dollar amount, you will lose. The market doesn't care how much money you're putting in. The market doesn't care how much money you're up. The market doesn't care how much money you're going to make. Okay? The market does not care about those things, right? So, we need to focus on probabilities. That's all trading is about, is focusing on probabilities. What is more probable to happen, right? So in this scenario, we got our, 1, 2, 3, our push, retrace, second push. We entered, right? So I put my stop loss above the wick. So that's the first place we can place our stop loss, above the candle's wick. And usually my stop loss size, it depends on how volatile the market is. If the volatile is moving very fast, then I'll have a bigger stop loss. And if there's like liquidity near, or if there's a fair value gap near that market might react off of and might reverse off of, we want to have a bigger stop loss just in case if it does reverse off of it and then go up and then come back down, we don't get stopped out and we can turn that losing trade, what would have been a losing trade, into a winning trade. So this one right here, 10 pip stop loss, you guys can see at the top. And if you place your position, you can see the risk to reward ratio. It's just a 1.14. So more of a smaller trade, but I've been taking smaller trades recently just because they've been doing me well, to be honest. So yeah, Stop loss above the wick. We're not going to put it at the level because it's too tight. We're not going to put it at the body because it's still too tight. We are going to put it above the wick. And as long as it's a 1-to-1, it's all good. It is all good. Now moving on to our take profit level. So we have this liquidity point down here. And what does it do? We come down, sweep this liquidity, and we would have came back up. If you did not take out at this liquidity point, you would have been basically stopped to break even on this trade. So for the first example, stop loss above the wick and take profit at the liquidity. Cool. Moving on. Alright, so this is a good one as well. So we get an entry here, pushes up, and as you guys will see, this is a bit of a bigger stop loss, right? So bigger stop loss equals a bigger take profit in a way, right? So stop loss, it's a very, very big candle, this one, and we want to be placing it underneath the body here. Because the reason why we're placing it underneath the body, or if you like, you can place it a little bit underneath the level, like maybe like here, but you still want to give it room to breathe, especially because when you enter a trade and it's still somewhat close to the level, sometimes price likes to come down, test that level, and then carry on going up, right? So stop loss underneath the body of this candle, bit of a bigger stop loss. Is it a little bit over dramatic? A tiny bit. Is that a bad thing? Not at all. It's better to be safe than sorry in the markets. And sometimes it's better to be a little bit more passive than a little bit more aggressive. Still be aggressive when you need to enter, you know you need to enter, but just have that passive stop loss. Because if you're getting good entries, then it doesn't matter if your stop loss is a little bit bigger. Because you're getting that good entry point into the market anyways. And for this one, the take profit is not liquidity. The take profit is this other level. We kind of had this little level going on. If you guys don't know how to draw levels, go check out the course down below. It is in the YouTube playlist. Go check it out, boys. This is a level because these are reacting here. Comes up, these are reacting here. And these are reacting all through here as well. So take profit level at the level. And the stop loss underneath the body. So now we know we can place our stop loss underneath the wick. And we can place our stop loss underneath the body, and we can take our profit at the next level, and we could also take our profit at liquidity as well. Cool. Moving on. And you want to be taking profit at the closest take profit that gives you a good risk to reward ratio. Like let's say we have a fair value gap right here. If our trade is able to take profit at that fair value gap with a good risk to reward, then by all means, go for the fair value gap and don't go for the liquidity point, right? So, in this case, you know, we had our push, pull back, second push, we enter. Stop loss underneath the level. So that's the third one. We can place our stop loss underneath levels, right? If we have enough room to breathe, stop loss underneath the level, right? Don't just put it at the level because sometimes it'll go touch the level and then continue going back up. Go at the level. Remember, the level is a point where price reacts, right? So a little bit underneath the level. And for this one, again, we had our take profit at liquidity as well. Again, as you guys can see, this one was 12 point stop loss. The other one we had like a 18 point stop loss. Every trade is going to be different. Never value your trade to be exactly like it was yesterday, exactly like it was last week. That's never going to happen. If you think the market that is changing every day is going to follow your risk to reward size the same every day, that is not how you become profitable. You are going to lose way more trades than you win. Cool. Next example, boys. These are great examples. These are literally back-to-back 4 days in a row, and it covers basically every single example, right? Cool. Last one. Now this one is pretty cool. So this is a two risk to reward ratio, right? So what do we have going on here? You could actually, if I would probably take profit at this little low here, but for this example, I'm going to show you guys, right? So when we are placing this trade, you guys, we have a little fair value gap going on right here. It might not be formed at the time of it when it was getting made, but it's all good because our stop loss is still above the body of the candle. But if we scale down to the 1 minute time frame, there is a fair value gap here. I'm not going to show you guys because I don't have to scroll all the way back, but if you guys trust me enough, I appreciate it. But yeah, so stop loss above the fair value gap and then take profit is also at a fair value gap. Now, there's three types of take profits you can hit at a fair value gap. You can do it at the close of the fair value gap, which is a little bit more risky. You can do it midway point of the fair value gap, with a little bit less risky, of course, with the closer, and the start of the fair value gap as well. In this scenario, both middle and top of the fair value gap would have been hit, but if you place that at the bottom, very unfortunate day from you. Like, how big is that? A pip and a half? Not even a pip and a half. It's a pip. A point. We're not trading Forex. It's a point away from your take profit. So yeah, there you go, boys. You can put your stop loss above or below fair value gaps, the wick of the candle, the body of the candle, and then for our take profit, we can put our take profit at a fair value gap. We can put it at liquidity. We can put it at a level. My bad, boys. So those are the three stops you can put, and those are the three take profits you can have as well. And like, if the trade is moving and you don't really see anywhere that you can put your like stop loss or take profit, to see how volatile it is. If it's more volatile, have a bigger stop loss. If it's less volatile, have a smaller stop loss. You know what I mean? But just make sure you are finding out the trade's personality, right? Because that's the most important thing. Finding out what type of trade is it. Is it more of a passive trade, or is it more of an aggressive trade? That's it, boys. We're getting one step closer to becoming a profitable trader. One step closer to getting these values down. And don't just watch these videos once. Re-watch these videos. Because sometimes you might watch it once, and you might pick up on some things, especially if it's a new concept, but everything's new, right? So there's lots of things. So watch it once, watch it twice, maybe even watch it 3 times. Pick up every single little bit of information you can. Really see where I'm placing my stop losses and take profit, and understand the reasons why. Right? Understand the reasons why. It's because it's a protected level, or is it because, it's more volatile, so I'm putting a bigger stop loss? You know what I mean? So those are the reasons why. Or does it have to be this big? Is it over dramatic? Maybe this one's a little bit over dramatic. Maybe it should be more like this, so we can get a better risk to reward. But I'm not going to go put it right at the level, because when the market's moving, especially if it's volatile, it'll come back down, stop you up, and then go to your take profit. Anyways, boys, let's jump on to the next concept. I'll see you boys soon. Let's go.